Thank you very much, Caroline. And it is a real pleasure to be moderating this opening session. I am Jessica Freese, and I'm the Exec Chair of Accounting for Sustainability. At A4S, we have worked in partnership with ACT on our work around debt finance and the role of Treasury teams to drive sustainable outcomes and sustainable business. One of our key programs is our CFO Leadership Network, and I'm pleased that a representative from one of our member organisations, NatWest, is on the panel. But we've done a lot to develop guidance to help Treasury teams embed ESG into their Treasury activities, our essential guide to debt finance, a number of case studies, and top tips to setting up a sustainable finance framework. And we're really finding that banks and their clients are focused on partnering and working together to enable them to set ambitious targets, particularly around climate, but also other ESG topics. And I'm really pleased to have three expert panelists to guide us through this discussion. And as we were finding out in the introductions to one another, we have three doctors in the house. So if we can't get off to an insightful start, then I'm not sure who would be able to get us off to a better one. So I'd like to introduce our three panelists. Robert King, he's the Head of Sustainable Finance at HSBC. Arthur Krebs, Head of Sustainable Finance Corporates at NatWest. And Gerald Podobnik, Chief Financial Officer, Corporate Bank at Deutsche Bank. So to get us started, I'd like each of you to share just a few headline thoughts. And Robert, coming to you first. What are you doing to support your clients set and deliver, whether it's ambitious climate targets or set other ESG goals and respond to some of the ESG challenges that they might be facing?
Yes, sure. Thank you, Jessica, and thank you for the invite today. So firstly, I'm Head of Finance for HSBC UK, which is the commercial bank in the UK, and we have as our clients large corporates, and they range all the way down to smaller SMEs. So we've got quite a range of corporates. And I mean, maybe just a reflection over what we've seen over the last year or so. I think one thing we've definitely seen is that sustainability has become part of a core strategy of a corporate now, and see more of them setting those medium-term targets. You mentioned it earlier, Jessica, some medium-term targets about becoming more sustainable, whether it's about carbon emissions or about waste. And we found that when we speak to our clients, again, you sort of bear in mind the profile of clients we've got, all the way from SMEs to large corporates. We spoke to around about 1,000, and about 3/4 of those said that they're already measuring a metric on sustainability, which I thought was quite striking. I think around 3/4 of those said that they planned to start measuring a metric around carbon very soon if they weren't doing so already. So I think that's one trend we've seen, the trend of measuring and setting medium-term targets. From a financing perspective, the one thing we've seen grow hugely over the last few years has been the growth of sustainability-linked loans. I'm sure we'll talk about them more later. You know, there's been lots of sustainable finance products around for a while. Sustainability-linked loans, we had the principles announced by the LMA 2 or 3 years ago. Having principles has definitely helped grow that market. I think now having corporates who have medium-term targets is clearly a need for that kind of structure. And we've seen lots of corporates across different sectors look to access that market and see lots of growth there. And that's something that we expect to continue.
Fantastic. Thank you. Arthur, same question to you. What are some of the key trends, key headlines that you're seeing?
Absolutely. Thank you, Jessica. Looking forward to this morning's discussion. I guess building on Robert's comments, a few trends we're noticing and how we, I think, are engaging with our corporate client base. I think the first one is that we're starting to move beyond a traditional, bank and corporate relationship. It's moving much more to a stage where it's two organizations, responding to the climate change emergency and sharing best practices. So already finding that as we as a bank decarbonize our branches and our offices, that's leading to certain learnings which we can then share with corporates attempting, the same thing. I think another element is it's much less driven by any individual product. We're often much more engaged in holistic conversations with treasury teams around embedding ESG into all aspects of their operations. Yes, that can be financing, but that's also how they think about bank and counterparty selection, how they place excess cash. And then I think another element is that of materiality. ESG can be quite a rabbit hole for a lot of corporate treasuries with the alphabet soup of jargon and of initiatives. I think we as banks have a role to play in helping identify those initiatives and those standards and those targets, to your question, Jessica, that are most material to a company and its investors. And I think a final element that I think we have an important role to play in is supporting alignment, right? That there's a risk otherwise that every bank sets different expectations when it comes to ESG, and every investor has a different questionnaire. I think that could lead to a lot of inefficiencies.
Yeah, I definitely think there's some of those topics that we'll be coming back to as we go through the discussion. Gerald, you've got a slightly different perspective. So in some sense, you're actually then at the coalface of this discussion. So your focus is helping Deutsche Bank to embed some of these issues within your own operations, and no doubt respond to some of these demands for information as well. So can you say a little bit more from your perspective?
Sure, and thank you very much for having me today. And maybe a quick sort of introduction, because as you heard, I'm CFO of a division of Deutsche Bank, but I'm also very involved for years in the ESG sphere. I'm co-chairing Deutsche Bank Sustainability Council, which is our sort of governance forum where we decide the strategy for the business and where we sort of steer out our organization in terms of ESG moves. And I'm honored to be a member of the Sustainable Finance Committee of the German government, which has been around now for 2 years and gave me a very interesting sort of look and feel of the political arena. But you're absolutely right, Jessica. I'm very much focused on typical crossovers between the worlds of CFOs and the worlds of ESG, which at the moment I would characterize as having 3 sort of main elements. One is the whole question of target setting, and both Robert and Arthur already touched briefly on it. The second one is performance management once I have those targets. And the third one, unsurprisingly for a CFO, is reporting. And I think, and a little bit what Arthur, building on what Arthur already said, ESG has moved on from a phase of PR years ago, but also, in my view, has moved on from the phase of chief focus on single product development to this holistic discussion that we're having today. And in a holistic world where the end goal is the transformation of the real economy, there are questions as, how can I set proper targets? How can I give them teeth by making sure that I include them in my strategic planning, that I link them up to compensation decisions that I have in my company, whether bank or corporate? And in the end, then what do I do in terms of communicating effectively with the outside world, with reporting that is material, what Arthur already mentioned, so to make sure that I am not just giving sort of a look and feel to the outside world of what the company is doing, but also that I make sure that I clearly link it with my everyday work, my everyday strategy, and make sure that I have some sort of a rounded and holistic performance management strategy behind it. So that's a big focus for us at the moment. And when we talk to clients, about products, about their strategy, about the transformation path, this question of performance management and reporting has become quite central.
Fantastic. Thank you. And just a word to everyone listening, please do post any questions that you have for our panel. I'll see if we can weave them in as we have the discussion, and leave a bit of time at the end to make sure that we can pick some additional up. I'd like to start though by picking up on one of the themes that all of you touched on, and it's around some of the products that you have touched on, whether that is things like some of the classic products, green bonds and other types of products that I think have been around for a little while, whether it is around credit facilities. Certainly what we're seeing is, from a customer perspective, more and more advantageous terms. A lot are talking about that really supporting them to drive action, and around the kind of interest from the market in some of those kind of products. So could you say a little bit more about the kind of products that you feel are supporting clients to move forward in their journey in this area, and maybe some of the challenges that might be faced, or some of the key things that people should be thinking about if they're wanting to access more finance? Should they be thinking about those specialist products at all, or should they really be thinking about how they embed some of these issues into their financing discussions as a whole? Arthur, maybe coming to you first.
Certainly, and I guess picking up on your final point, Jessica, in terms of should people be thinking about these products? When we survey investors around, what does a company need to do to show that it's committed to sustainability, quite consistently, the number one answer is around improving the overall quality of sustainability reporting. The number two answer is around improving overall ESG rating. So the message is very much get your house in order first, before coming out with sort of a flagship green bond or sustainable debt instrument. So I think that sequencing is important. Now, of course, doing a sustainable debt instrument can be an important catalyst. There's all sorts of halo benefits that we're finding to doing that. And I think what is exciting is that, while that market began from a traditional public bond, in the last 24 months, there's been a lot of innovation across all banking and capital markets products. So I think in a few years as a treasurer, you'll get to a stage where you don't have to compromise your instrument selection for your sustainability objectives. Now, there's two technologies that tend to be embedded into these products. It's either this use of proceeds technology, every pound that I raise, I'm going to invest it in something sustainable, or it's that sustainability linked technology where the margin or the pricing or the coupon is linked to meeting sustainability targets. We see them as complementary solutions. There's no right or wrong answer. So as a client, you need to look at both, but they are both still at a very early stage of development. And, use of proceeds, it's still a little bit of a gentleman's agreement. Nothing really happens if the money goes towards, non-sustainable means. And then in terms of sustainability linked, as you were discussing at the start, Jessica, there is still a challenge around the setting of ambitious targets so that margin component or that coupon component has real option value. It's not just a bit of a worthless add-on.
Robert, how does that compare to your perspective?
Yeah, I think I agree with the order of events. Clearly the customer, the corporate needs to have a sustainability strategy in place and have that embedded in their business, certainly before they can look to access the sustainability linked loan market. That product needs medium-term targets for it to work, and it's certainly not the case that banks are responsible for setting those targets. It's it's very much the corporate that creates them with external help, external consultants, and the banks will challenge that, but it's certainly not the bank's role to set the targets. So first point, absolutely, the corporate needs to have that that's in place. Again, there are those two use of proceeds products. I think standards have definitely helped in both markets. There's been some update to the sustainability linked loan principles a couple of weeks ago, which from our perspective were helpful. I think the whole world of target setting and materiality matrices is now a little bit clearer. We certainly welcome the drive to look more at benchmarks for setting medium-term targets, and that's really important. So we've got consistency across the market.
Both Arthur and Robert have touched on that importance of getting your own house in order first. As a CFO, finance clearly has quite an important role to play in terms of that quality of data discipline. Can you say a little bit of some top tips that you might be able to share in terms of the key things to focus on in really making sure that that the information is there, that the strategy is in place before you go to market, and then of course continuing to report once you do?
Let me maybe park the question for a second, because I would also like to add a couple of words on your previous question about the role of those products. Because what we observe is that these products, whether use of proceeds or whether a KPI link, they can actually be a very sort of effective tool to be used by the treasurer or by the CFO to clearly integrate sustainability into the strategic heart of the corporate. What we usually see when engaging with clients on the topic, and especially with CFOs and treasurers, is that they say, you know, sometimes I had a little bit of a hard time as a finance function to make sure that everybody in the organization follows the decision to make sustainability core of the strategy. But once I did such a banking or capital markets product, there was no other choice, because suddenly the corporate had to define what's sustainable or not, had to set up a governance to decide which sort of projects go into the financings, which won't, had to track the proceeds, had to set the KPIs, and had to, and I think we said this already, had to improve the reporting. So I think what I always say is, for me, philosophically, these products play a really important sort of toolbox role to help finance departments of a company to contribute to the overall sustainability strategy by just making this a tangible sort of measure that companies can do, in addition to everything they do in their usual sort of day-to-day business, including production, distribution of products, and so on and so forth. I think that I for me is quite important. So to your second question, when it comes about data and keep your house in order, as you said, I think that the top tip that we also try to do in our own organization when we embarked on the journey about 2 years ago to change the way the Deutsche Bank looks at sustainability is to be really, really stringent and take your time. So, for example, if you noted, we have sustainable finance targets ourselves. We said we would like to have 200 billion euros of sustainable financing and investments, including our asset manager DWS, done originally by 2025. We were not one of the first banks to do that, and this was precisely because we wanted to have our house in order first. We wrote our own taxonomy based on the EU taxonomy. We clearly had to sort of broaden our strategic planning tools with which we plan 5 years ahead, every subsidiary, every business line, every region, that we can include those targets. And then we had to sort of broaden our compensation tool, where we use a balanced scorecard to include these metrics. And then secondly, we decided to bring the target forward to 2023 and not join the race for huge, gigantic targets in the trillions that are further out, because we wanted to have it near-term and measurable. So I think that would be my top tips. Take your time, make sure that you make up your own mind as a company of what you actually would like to achieve, build it really in your day-to-day performance management and finance processes, and do not necessarily follow every headline, right? It's more important that you deliver stuff to the outside world that's tangible, that's measurable, and that's sort of near term, because we are convinced that the action for sustainability has to happen now and cannot be delayed to the latter part of our decade.
Picking up on the point that I think everyone has touched on disclosure regimes. So we're seeing a lot of push for companies to be reporting on some of these topics. You're seeing convergence towards global standards, but we're not there yet. And you're seeing a real regulatory push on banks to be looking at their own disclosure, and particularly accounting for financed emissions, which of course then I think banks are needing to go to their clients to get the data. And so there is this risk that a few of you touched on, of multiple different information requests. Can you each share your perspectives on that whole myriad of different disclosure regimes and regulatory frameworks that are emerging, and how companies can navigate through these, and potentially some of the actions that collectively could be taken to really accelerate towards harmonization? Gerald, I'll come to you first this time.
Yeah, I think standardization, as you said, is the ultimate goal. And what I constantly call for is real work now on details and on quantitative information. I think there's lots of ideas out there around the globe about structures of reporting, about principles, about qualitative information. So I would park that for a second. But capital markets and the wider financial community always works on standardized quantitative reporting. So what we now need, we need clear understandings of which KPIs we would like to have and how we actually really calculate them. And there I feel we have a lot of work to do, because there are still too many ideas around, and there are still, I think, too little guidance for companies in particular to which sort of path they will follow. I'm pretty convinced that with the entering of the IFRS or IASB in the arena, we will come to sort of a global standardization. And there are lots of projects at the European Union level as well. But what we really need in the sort of run up to this global standard that will somewhen arrive, we need to understand which decisions companies can actually make and how this would compare to their peers. And there again, I say a lot of work has to be done. Just take as an example, the green asset ratio, where we're still waiting for the final delegated act, as we as banks will have to disclose as of next year and then in a sort of more refined way beyond. There are so many variations that you can take how you source the data, from actually asking your client for data, from analyzing every transaction, from taking sort of a fallback approach by using industry NACE code defined coefficients. But there is no clear guidance of how you actually could sort of, what's the journey that you can take in terms of moving maybe from a sort of fallback solution to a very sort of detailed client interactive solution. And this guidance I'm really missing. So whenever we speak to industry bodies, whenever we speak to clients, whenever we speak to standard setters, this is what I'm really calling for. What I would like to see, for practitioners like me as a CFO, clear KPI guidelines and clear decisions of how data sourcing could be justified, could be explained, and then also could be audited. Because what we shouldn't be forgetting, we are moving into a world of increasingly strict audit assurance standards for non-financial reporting. Some of us already have limited assurance. Some of us are moving into the world of limited assurance, and then reasonable assurance. But for all of this, we need to get a little bit of more guidance of which data procurement processes are considered acceptable. I think that's really the work that the overall industry, the accounting industry, needs to focus on for the remainder of the year.
Robert, how about you? What kind of advice do you give your clients in this area?
Yeah, I guess I've got a slightly different perspective. I think about it from my perspective, I have a team speaking to clients about things like sustainability loans. So I'm thinking about the KPIs that we mentioned earlier. You know, what are we looking for there? I mean, standardization is clearly key. You know, I mentioned earlier, we see lots of variance across that market, and knowing what are the right KPIs in a certain sector, having consistency across that sector is really important for the banking industry and for our borrowers. I think having benchmarks are important. There are benchmarks in things like carbon emissions. You have the science-based targets. Other KPIs, it's less clear what the benchmarks should be. But I think that's a really important part of setting medium-term targets. And I think what's been really helpful in the new LMA's guidance has been some clarity around assurance. So when you are reporting these targets to your banks or investors, it's really important that performance is assured by somebody. There has been a bit of a trend in the market not to have that in certain financings. I think it's welcome now that it's clear that that's now required for this kind of instrument.
Arthur, anything to add?
Sure. Yeah, I think just to set the scene, Jessica, I think you mentioned this indeed array of different disclosure requirements and standards. I think, I would split between two categories there. I think that's a sort of global minimum, right? These sort of standards that are becoming mandatory or becoming just the norm for all sorts of sectors, whether that is TCFD, whether that is the EU taxonomy. And then there's this sort of wild west of other voluntary disclosure standards. And when I'm working with clients in terms of navigating particularly that second category of sort of more voluntary standards, I think there's a couple of sort of tips and sort of best practices that we see. I think one is investors don't tend to be religiously wedded to any one of these sort of voluntary disclosure standards. No investor will tell you, oh, it needs to be SASB, it needs to be GRI. They're more interested in understanding the context that led a company to select a particular disclosure regime. So contextualizing that, how did you come to that decision, is important. Something that can work very well for certain companies is a stakeholder survey. So asking stakeholders what areas of disclosure are most important to you. That can be investors, that can be suppliers, banks, other stakeholders. I think another area is, be open to outsourcing some of the data requirements. That there's a fantastic array of new ESG data products being rolled out with the help of AI, of machine learning, that can really help, particularly the SMEs and the smaller companies that just don't have the in-house capabilities. And then a final area that's becoming more and more a trend is getting a solicited ESG rating. So if you want a little bit of a second opinion, a little bit of a benchmark as to how your company is perceived from a more holistic ESG perspective, getting that can be quite powerful. While noting also there are hundreds of different providers, you need to be quite considerate in who you select.
One of the key topics this year is in the build up to COP26, more and more organisations setting net zero targets and really thinking about specifically climate and the risks there. I'd like to start by getting each of your thoughts on some of the things that you're doing to really help organisations to understand what kind of target they need to be setting in that area to be able to access finance, and particularly thinking of some of the high impact industries, how you're helping those industries to transition, and whether you think finance is already starting to be impacted for those industries as more and more banks set their own net zero targets and are under a lot of pressure to be supporting that transition to net zero, potentially withdrawing from certain high impact industries, and some of the really tangible things that you're doing to enable that transition. So Robert, if I could come to you first.
Yep. So I think the way that we think about it at HSBC, I think it was referred to earlier, the first part of our role is making sure that our relationship managers, each client has a relationship manager, is speaking to their clients about sustainability as a strategic topic. We think that's really important, and we've put in place training to make that happen. And we also have a network of sustainable finance ambassadors across the commercial bank in the UK. They are volunteers who do this on the side of the desk. They're given the time to do that by management, and they're given the opportunity to get an external certification in sustainable finance. So I think it's important that our frontline staff can speak to their clients about this topic. That's our first role, to have the right conversation with them. And then if we think about the role that we play, clearly big part we can play is around financing. All of this transition is going to require a huge amount of investment, and the financial industry's got a huge part to play in financing that. That might be green loans, it might be other things, but that's a big part of what we do. And HSBC, like others, has made commitments about the amounts of financing that we're going to provide to realise transition. I think the second thing is making sure that we have the right kind of solutions available for clients, and that might be the products we've talked about earlier, or it could be other things. So we are looking at various tools that we can use for some of our smaller clients. Clearly we can't, but it's very difficult to have detailed conversations with some of our smaller clients because we have so many, but there are digital ways of helping and giving insights. So we're looking at that as HSBC as well. I think that's an important part. And the third thing for us is just this whole thing about, I don't really like the word, but thought leadership, bringing insights into what transition means in certain sectors, because it is very sector specific. Looking at things like, even for our smaller clients, how do you get started with sustainability in the first place? How do you set a net zero target as an institution? We have a guide that we produce with Carbon Intelligence. And we also have some more big picture thinking around new technologies through our Centre for Sustainable Finance. So for us, it's those three big topics. It's about the financing, it's about making sure we have the right solutions, and providing that thought leadership.
Arthur, how about you?
Absolutely. I mean, we are incredibly excited about the run up to COP, where we're the main financial sponsor of the COP conference in Glasgow, and certainly some parallels with what Robert has shared in terms of areas of focus. I see this move away from pure bright green focus to transition focus as very important. This needs to be a broad church. We need to get a wide range of the economy to transition. And to give you one example, you know, we as a bank have announced we'll divest from oil majors unless they have a credible transition plan. So we're trying to sort of balance that in our own sort of financing and decision making. I would say though that, you know, setting a 2050 or 2040 net zero target is very much just the first station of the journey. There's a lot more that needs to be done. And when you speak to large investors, you know, for them, the scrutiny goes much deeper, you know, and then when we're helping clients in advocating and explaining their sustainability strategy, and the areas of focus are much more around what are the intermediate targets, right, 2025, 2030, within the realistic career of a lot of treasurers and CFOs. What's the implementation plan as well? What kind of business units will you be divesting? What investments will be necessary? What's the governance around meeting those targets? And what are the KPIs that you'll be assessing your business with as to, you know, success of that trajectory? And when it comes to KPIs, not so much the input KPIs, you know, we're going to spend this much million on transition, but the output KPIs, you know, what will that do to your business model? And as Robert said, for a lot of these things, the implementation, the investments that are needed, you know, we're rolling out a broad range of transition-friendly instruments to support that.
Into some of the audience questions as well and weaving them in. So to build on this particular topic, should you set really ambitious targets that you may fail at? Or is it better to set safe targets which are more achievable? And what will the resulting market effect be? So who would like to answer that? Gerald, maybe coming to you.
It's always a big question, right? What do you do? Do you set ambitions for yourself that are ambitions, or do you just play it safe? I think my view is that given climate change is such a sort of momentous task, I would always tend towards the more ambitious side. Because as we said in a couple of statements in our panel so far, there is quite some, I would say, improved focus now in understanding of pathways, of transformation journeys, and of levels of ambition. I think that the time, in my view, just put something out there that's anyhow easy is sort of gone. And given we are on this trend, and you mentioned it, Jessica, in terms of net zero pledges, I mean, if you pledge net zero and you set targets on the way, then these targets better be ambitious, because otherwise you definitely will fail. So I'm a big fan of setting realistic targets, which at the same time are ambitious. I'm not a fan of such setting targets that you anyhow easily, pass. But I'm also warning against setting targets that are completely unrealistic, because this will only harm you. So I think, as always in life, it's some little bit in the middle. Make sure you have something that's credible, that's measurable, and that's sort of, as I said before, that's not necessarily long-term only, but that has an ambition level which you can defend, and you can also motivate your internal and external stakeholders to get behind.
Yeah, and I think that something that we've definitely seen around that is that you may know how to achieve the first third of the target. The next you might have some idea of how you will. There'll be that tail end that really is potentially a little way into the future. Where you're trying to get to, and that's where some of the really big wins and innovation might be coming in, but it might take longer to get there. So definitely support that. A key question here, and I think that this is an interesting one to get everyone's perspective on, is moving beyond the finance focus. So thinking of some of the other treasury activities, how can you bring ESG into the cash management world? Who would like to answer that first? Arthur.
I think there's two angles there. I think the one angle is that we are starting to see the rollout of ESG deposits, ESG-aligned money market funds. And certainly they're amongst the fastest growing ESG investment products, interestingly. So I think that's one to explore, and then more companies are embedding that in their cash management policy. And then the other element is counterparty surveys. So when you're selecting a bank or other counterparty to place cash with, Are you looking just at the rates or at sort of the bank's product mix? Or are you also looking at the bank's ESG values and priorities? I think those two areas can be quite readily implementable for people within the cash management department.
Robert, you wanted to add to that?
Yes, I mean, it's not maybe not directly related to the question, but of course we haven't talked about the various, I hesitate to bring it back to products again, but there are products on the liability side as well, of course. You know, there are things like green deposits. You know, HSBC and others have green deposits, which are, you know, they are backed by some of the activity we do on the financing side. And there are obviously, you know, green variants and ESG variants of the various other investment and money market products that banks provide. So there are, you know, there's both sides of the balance sheet from financing and the liabilities.
Yeah. Gerald, I'd like to put one of the other questions to you. So as corporate customers, how can companies put pressure on their banks to engage with and commit to net zero, but also potentially other topics? You know, who has the power, and how can companies really drive the conversation in the other direction?
That's a very, very good question. And I think, you know, the corporate is the client, right? So they have all the power basically by explaining to their banks what makes them an eligible counterpart or an eligible financial provider or service provider to them. And that's actually, I smile because as you can imagine, for banks, when you take out the business people and when you move more towards general management of a bank, there could also be the voice that all these efforts that we are doing in terms of setting ourselves targets, in terms of improving the reporting, in terms of getting ever more granular on data provision, in terms of improving our governance, that all of this is actually costing money to the bank, right? And I'm always saying when I hear this, well, but the only way that we can be a credible, sustainable finance provider and can actually be there as a partner for the ESG transformation of the real economy is when we do all this homework and when we present ourselves as being a credible partner. So I would actually say that in this sort of double sort of edged sword, where you would say, look, a bank can decide not to finance a certain industry. As we know, there's a lot of money around in the world. The client might find another financing solution. So I would put the power chiefly actually with the clients. It's in their power to motivate banks to be as credible and as involved with ESG or with sustainability, to continue to be eligible as counterpart, a service provider, and for motivate us banks to fight hard to win a high share of the wallet that the client has to offer.
Fantastic. Now we've got time for one more question, and then I'm going to come to each of you for just your final thoughts, your final takeaway that you want to share with everyone. So a bit of a warning on that, but before we do, I'd like to cover one last question from the audience. So focused on risk appetite. So the question is wondering whether defining risk appetite in quantitative terms, critical success factors, are aspects to consider. Arthur, what are your thoughts?
Yeah, it's a great question. You know, as a bank, we've identified in particular climate change as a top-line risk that's going to be critical for all of the exposures that we have. And I think we're going to be moving to an environment where any advanced risk management policy or function will have embedded, you know, key carbon, key social, and key governance considerations. I think we're moving beyond credit risk as just sort of a next 1 or 2 year risk of default type of analysis. It will become much more holistic, and you're already seeing that with the large credit rating agencies and how much more vocal they are becoming around ESG drivers to their methodology.
Great. So Robert, I'm going to ask you first, just your closing thoughts. We've had a pretty wide-ranging discussion. So what is the 1 or 2 key things that you think everyone should be doing from this conversation to facilitate that relationship and drive action on ESG? Yeah,
I think I'd probably just say maybe one thing. I think, you know, just be aware that banks are, to Gerald's point earlier, you know, banks are really focused on this. There's various reasons why we are, you know, from both looking at climate risks, to our regulator asking us to look at more disclosures from our own stakeholders' expectations, and that includes our own employees. We're really focused on this, and we're really engaged in enabling this transition, and we want to talk to you about helping you through that journey.
Gerald, how about you?
Yeah, so given this is a corporate treasurer conference, I would like to address my final words to my finance colleagues at corporates, right? Because treasury obviously is a sort of a finance function. And my main messages are twofold. First, performance management is absolutely key to make sure that your company makes the best out of the ESG transformation. So you in your finance function, you have a vital role in actually steering the company onto the right track. This cannot be underestimated, not just in terms of reporting, but also in terms of ongoing performance management. And the second, what comes with this, because I've seen this in my own team, and I'm really, really pleased with this development, gives a great new sort of identity project to your teams, to your finance organization, by being involved in something that's big and that goes beyond the usual finance rhythm of reporting, of doing resource allocation, of doing strategy, of doing risk management. It goes beyond this. I think it's also a great team motivator. It's sort of a great talent acquisition topic. So make sure that in your companies, you raise your voice as the finance department and play your role with optimism and with pride.
Fantastic thoughts. Arthur, last word to you.
Very briefly from my end, also two messages. I would echo Gerald's call to action. As a Treasury team, take ownership of this agenda. It's become part of your day job, and also it's becoming a defensive play. If you don't articulate your sustainability narrative to investors, they will perhaps draw their own conclusions. Second message: this is an iterative process. A lot of Treasury topics are relatively statically to manage. When it comes to ESG, because it's ever evolving, recognize that you'll continue to have to adapt your approach and priorities.
Fantastic. So thanks to all of our panelists. For me, there are a few key things just to reinforce. So firstly, definitely get started in this area. And as Gerald highlighted, starting to think about some of the products, some of the actions that you can take is a great way of driving some of that internal conversation and getting that buy-in. I love the point around clients having the power. So do challenge your finance providers on what they're doing. Really create that partnership. And as I think today's discussion really demonstrates, there is an open door in this area. You definitely need to be setting those ambitious targets. The market is moving fast. And finally, just do have a look at the Accounting for Sustainability guidance, lots of practical tips, case studies, and more to come around net zero in the coming weeks. Towards the end of the month, we'll be releasing some more guidance. We really value the support from ACT and all of the Treasury and banking community in creating that. So thank you very much and enjoy the rest of the conference.